Okay, good afternoon, ladies and gentlemen. I think I'll kick off a minute early, so if there's any latecomers, they can catch up, hopefully. So my name is Gavin Richardson. I'm head of sales at Mortgages for Business. We are a specialist mortgage broker, been in the market for about 30 years. And this afternoon, with about half an hour of your valuable time, I'm very conscious it's kind of post-expensive sandwich lunch and the graveyard shift. But I'm going to take you through a few of the basics of how to finance property, a buy-to-let property, a little bit about the market itself, and where potentially you need the assistance of a specialist mortgage broker and how that can help you in your property portfolio journey. So just so you know who you're talking to or who you're listening to, my name, as I said, is Gavin Richardson. I've been in the industry for about 20 years, obviously straight out of primary school. Head up the sales team here at Mortgages for Business. Mortgages for Business have been in the industry for 30 years, and we've got members of the team that are still at the same desk 30 years later. We've set ourselves up really specifically to look at the specialist areas of property finance. So we have buy-to-let specialists, we have commercial specialists, we have development finance specialists, we have residential specialists, we have short-term funding specialists, and we have specialists that actually cross over all aspects of it. And I think that's a really important factor when you're actually considering who you work with as a client, because these guys and girls aren't just specialists in how to do a mortgage application. You know, they take it on board so they can actually understand the industry, the market, the geography, the demographics, the lender's criteria. And again, that's another really important factor because lender's criteria is evolving all the time. Mortgages for Business, as I said, has been in the market for 30 years, and we've actually helped shape a lot of the lender's criteria as well. So new lenders that have come to the market in the last 5 or so years, Axis, Zephyr, people like that, for example, we've actually helped write their criteria. You don't need to see that. The other thing, I suppose, just probably worth pointing out, whilst we've been in the industry for a long time, we're actually pretty significantly pleased with what we've achieved in that time. So 7 out of the last 8 years, we've actually won Mortgage Broker of the Year, and 2 of our existing team are currently Broker of the Year as well from industry recognition. So we're quite comfortable, we kind of know what we're doing, which is nice and hopefully reassuring for you. What I would say is just to the back left of where you are sitting at the moment is our stand, Mortgages for Business, number 420. At the end of this, if you haven't got questions that I can't specifically answer, we've got a very experienced team. If you haven't got your copy of First Rate on your chair, you can pick it up there. And there's some other really useful data that we actually produce on a regular basis, such as a guide to HMOs, tax guidance for landlords, and frequently asked questions. The First Rate magazine is produced on a monthly basis and is really insightful, full of lots of information that you guys should be up to date with, but if you're not, then hopefully that will keep you up to date with it. So in terms of what I'm going to cover today, we're going to look at the market, and we're going to look at the market both in what it means to you and what it means to the lenders, I suppose, in all seriousness, and why people are actually choosing to still invest in buy-to-let, i.e. why you guys are still here. We're also going to share some of our experience in actually why people are doing it and where people are doing it now, because I'm sure you've seen other presentations today that talked about rental yields and talked about potential new build properties and buying overseas and buying off plan and buying in this area, buying in that area, getting fantastic returns if you do it in a certain way. We're going to talk to you realistically about, from our experience, what people are actually doing. So we're seeing a trend. It used to be that you were buying prime location properties for significant funds and getting decent returns on them. We're seeing a migration of landlords now looking at North East as a property hotspot, and that's Manchester, Birmingham, Liverpool, Leeds. They've always been traditionally good rental areas because of the universities that go with them. But I think because of the lower property price and higher yields, people are taking advantage of it. They're going southwest, they're going Exeter, they're going Bournemouth, okay? And they're going Cardiff, Wales, those sorts of areas as well. So we're seeing a migration into different areas, what were potentially not as traditional buy-to-let areas. Another significant factor in why they're going to these areas is potentially changes in legislation around things like HMOs. And we're seeing lots of landlords now taking advantage of conversions to 4-bed houses into HMOs, taking advantage of student market, and the lender's criteria adapting to actually support that trend. Okay? From the market's point of view, there's a resilience. I think we're all aware that Brexit is the kind of elephant in the room and everyone's thinking, is now the right time to buy? Should I be going into property? Should I be selling? Should I be incorporating? What should I be doing in my existing portfolio? We can't, I suppose, ignore it, but from one aspect, what we have to look at is banks are really well capitalised at the moment. specialist lenders have got really secure funding lines, and lenders actually do need to lend the money. So the opportunity to actually borrow at what is really competitive rates has probably never been better. I think lenders are also getting to grips with what is needed from your point of view and the ever-changing market, and to seize an ever-changing opportunity in property dynamics, their criteria is changing rapidly to actually adapt. So what used to be a no-go is kind of actually, there's a few lenders actually dipping their toe into different markets. For example, if you look at, we talk about Brexit, you get the obvious fall in the pound, and then more and more lenders suddenly going, actually, we'll do non-UK nationals, we'll do expats, for those people taking advantage potentially of a falling pound. So, other aspects of what we'll look at today, I suppose there's some boring data, which will actually hopefully give you a little bit of confidence. So the proportion of households in the UK that actually fall into the rental sector has not changed for 5 years. So in one respect it says, well, actually the rental market isn't growing, but it actually also shows there isn't enough properties in the rental market to meet the demand. Okay? So if you've got 19% of all properties out there actually fall into the private rental sector, 4.5 million properties, that's a significant market at the moment, but not enough to meet the demand. And I say that because actually, if you look at the average age of a first-time buyer, they're 35. But the average person leaves home normally 2 years after university, so around 22, 23. So they're sitting in this rental market for quite a significant amount of time. And when you look at the kind of third paragraph down, and actually the increase in renters with children or with dependent children, they're going into the rental market at 24, 25 and actually realising it's cheaper and easier to start a family than it is to buy a house. And you come down to the last point on the slide where actually the average age of a renter is now 40, they're staying in that rental market for quite a significant amount of time. There's an interesting stat that's not on this slide, that if you were going to buy your first house now, the average income in the UK is just over £27,000. And when my parents bought their house, I think it took them 6 months to save their deposit. If you were buying in London now on that average income, it would take you circa 19 years, if you were currently paying rent, to save up enough to get a 10% deposit on the average house price in London. So if you're in the rental market as a tenant, the chances are you're going to stay there for quite some time. Couple all that data with the fact there isn't enough houses and isn't enough property on the market, then you can see that actually the rental market should remain pretty strong for quite some time. Other statistics that potentially back that up, we mentioned Brexit, but residential house sales have subdued. They're not rising, they're staying fairly constant. There's growth in certain areas, but there always will be. But the house price index is not rising like it used to over the last 5 to 10 years. It is anticipated that that will rise over the next 12 months. This data was obviously written by Ricks, assuming that we would actually have a Brexit deal by October. But nonetheless, it still looks like there should be demand for the housing market over the next 12 months. But rental growth over the same period is looking at a 2% growth. Now, I looked around and I've been in listening to other people's presentations about yields and great returns and property investment returns, but let's be realistic about actually what we're getting. There is a supply and demand issue. There is a housing shortage, and tenants can only afford to pay a certain amount of rent. But it is your market in terms of setting that rent, and with the right property, attracting the right tenants, the returns on rental property is likely to increase by about 2%, data from Ricks, over the next 12 months, and potentially, because of that supply and demand issue, increase to 3% maybe over the next 5 years. I think this kind of continues to demonstrate the need for your sector. You know, you couple that with the fact that the government hasn't got a very good social housing policy, therefore there's people out there that can't get the houses they need, and that gap is being filled by you guys as landlords. So the demand is high. Other reasons really why the market is strong. If you look at property as a pure asset, as an investment, and research was done on why people actually go into the property as an investment over any other asset class. And I think there's a surety, because you've actually got a physical asset in front of you, and a kind of surety that you're not putting all your eggs in one basket, because you're only realistically funding 25% deposit, so it doesn't feel like it's all your own money, whereas if you're buying shares, it kind of feels like you're all in one basket. So people kind of prefer to supplement maybe their investment strategy with property. Property has always been seen as a really good pension. And actually, 44% of those people actually in the market see it as a supplement or a replacement for their pension. With the decline and disappearance of defined benefit pensions, then it really does kind of fill the gap for it. But realistically, actually as a rental market, only 4% of actually all these landlords are professional landlords, i.e. 100% reliant on their rental income for all their income. The rest of it is a supplement, a complement to any other investment strategy. And we kind of wholeheartedly believe that, in terms of if it's there as an opportunity to balance out any other risk or support a pension, then it's a good strategy to have. It's not the only strategy to have. And then we looked at this. So hopefully you were all aware that kind of around 2016 there were some significant changes in how you fund your property. Section 24 sort of came into play around the taxable advantages of actually owning a property in a limited company. And some significant changes implemented you as owning the property in your personal name on how your rental income was taxed. So people kind of really understood that in the first year, in sort of tax year 2017-18, when they saw their first tax return and realised the implications of it. So purchases or potential transfers into limited company or buy and sell into limited company have started to pick up. So from around 2018, we kind of saw about 11% of the market being purchased in a limited company, and that's increased to about 15% of the market in limited company applications going forward. And there's lots of kind of myths around buying in a limited company, which hopefully I can dispel with you guys today. It used to be, if you bought in a limited company, it's far more expensive. They charge much higher rates. And that used to be kind of the case, because there was only a few lenders that actually operated in the limited company market. I think it kind of in the PRA made their announcements to change it in 2016. There was about 13 lenders in the market for limited company, which has grown to over 25 now in the last 2 years. So the actual appetite to go into limited company has actually driven rates down, and most of the lenders in specialist lending markets now have got the same rates whether you're buying in limited company or you're buying in your personal name, which is a positive. I'm not going to dwell on this because it's depressing if you own your property in a limited company, but this kind of highlights the implications of actually if you do own it in a personal name, the implications and the difference between your tax bill prior to the changes in 2017 and what they will be after 2020. In real terms, you're going to be about £1,140 worse off if you do nothing, in terms of you still own that property in your personal name. It used to be, just without dwelling on it, with this example, if your rental income was £950, your mortgage payment was £600, that £350, okay, you thought, well, I'll pay tax on that. But you could offset your £600. So you would only pay tax on that £350. Going forward, you can't offset that £600. You'll get 20% tax relief on the £600 after this period, but you cannot offset your £600. So the clear advantages of owning in a limited company are black and white in terms of financial. We are mortgage brokers. We won't give you the tax advice to do it. You need to speak to an accountant to make that decision. But we are seeing, probably as an industry, and to kind of put it into context, we can't tell you what to do in this scenario. But as a company, we probably facilitate about 300 mortgages on average a month, and about 80% of those will go into a limited company. So it's kind of speaks for itself in that respect. So one of the key things for you guys is actually how we facilitate a mortgage application. Because while it's quite easy to talk about great returns, why you should do it, supplementing pension incomes, you're all going to be millionaires and retire in 12 months' time, life is easy. If you don't get it right at the outset, it's going to become quite a painful process. And it's a more painful process now. Let's not shy away from it with all the PRA changes. And if you are fortunate enough to own 4 or more buy-to-let properties mortgaged, then lenders are going to be a little bit more inquisitive about your existing portfolio and your tax affairs going forward. So a straightforward application is, in real terms, a thing of the past. And it's important you understand how lenders will look at it and how brokers will look at it and how you need to be prepared. So keeping it really simple from the borrower's point of view, you'll see it on most things. Most lenders will say, well, income. And lenders will either want a minimum income or an income over 25,000. Now, when they say no minimum income, they still need an income. And look at it really simply. If you're going to go into a mortgage application with 0 income, you're fortunate enough to have the deposit, the lender's going to be concerned about what would happen in a rental void period. If you have a tenant that moves out and you don't find a new tenant quick enough, who's going to pay that mortgage in that time? And if you've got no income, they're going to be concerned. So they want enough evidenced income in the background to make sure they can cover a rental void period. Now, that income doesn't necessarily need to come from employment or self-employment. It can come from your existing portfolio. It can come from your pension. We've used applications before where self-invested pension income for drawdown has been used as an income. So they are sensible about where your income comes from, but they will need evidence of it. Age is a really interesting one. You can buy a mortgage or you can get a mortgage at age 18. Most limited company applications want you to be at least 21. But the maximum age has really changed significantly over the last few years. So we've rather remissly kind of called some lending out there at the moment let to die, because you can start a mortgage application at 89 and do a 35-year term, which is interesting from longevity point of view, but they're out there. You can do a mortgage age 90 if you're an experienced landlord with no maximum age whatsoever. They don't care on a buy-to-let deal. Okay? Other lenders have different criteria and they'll bring it back down to actually being 64, 65, and actually if they're concerned about your income, then they're more likely to have a lower maximum age. But it's changing, demographics are changing, geography is changing, you guys are living longer, we're hopefully all living longer. So lenders are actually adapting quite quickly to actually what is minimum, maximum ages for the applicant. When it comes to experience, you can still get a first-time landlord in a limited company application with most lenders. So there's no myth about actually you need to have experience to be the director of a limited company and go in and buy a mortgage. They will want you to have your own residential mortgage in the background. If you don't have your own residential mortgage in the background, then they want to make sure that you can afford to buy that house as if you were going to buy it residentially. Otherwise, you'll come to me with no minimum income, with a deposit, say, I want to buy a house, and lo and behold, 6 months' time, most lenders think, well, where's your onward address? You might actually just moved into your buy-to-let. And they're savvy to it, they don't like it. So first-time landlord, first-time buyer, possible if you've got the income to buy it normally. First-time landlord and you own your own residential, most lenders, no problem whatsoever. If you're going into a more specialist property, if you're going in to buy an HMO and you are a first-time landlord, most lenders will expect you to have experience of owning an investment property. Whilst we all know that actually an HMO, a multi-unit block, actually provides great income, probably better security, because if one tenant isn't there, 4 others are, and that covers the rent, no problem. Lenders look at it differently. It's harder to manage, more complex, different legislation to keep up to date with, you need experience. There are lenders out there that will allow you to go and be a first-time landlord in an HMO, but it's about knowing which lenders to use. In terms of employment, we kind of covered that you can be self-employed, you can be employed, you can be pension age and just taking retirement income, or you can have no employment whatsoever as long as you've got a provable income source. The only point probably to navigate around there in what vehicle it is that you purchase your property in. If you're buying in a SPV limited company, it's not a trading company, it doesn't need income. If you're buying in a trading company, which you can do, they will want 2 or 3 years worth of evidence of income in that trading company to make sure any deposit that you use or any impact of buying the buy-to-let has no negative impact on your trading company. Credit profile is always an interesting one. Of course, most lenders will want you to have an absolutely squeaky clean credit profile and a 999 Experian report, green all over the place, but that's not reality. Lenders are savvy to this now. They're not going to sit there and penalise every single blip you may have had on your credit report. They will want nothing to impair a secured debt. But if you've got missed payments, potentially utility bills, mobile phone bills, which seem to put defaults on your account within 2 days of you actually moving at your previous address to your current address, they're going to be sensible. If there's a justifiable reason why you've got some blips on your credit report and we can evidence the reasons why, lenders will be supportive of those types of decisions. They will want evidence to support it, but they will be supportive of it. And I've put deposit on there, because deposit's really a kind of frustration from a lender's and broker's point of view. So many applicants come to the point thinking, I've got a deposit lined up, and don't worry, it's in my savings account. And what that actually materialises is it's a gift coming from my auntie to my uncle via my sister to me, or I'm going to sell this, or when I sell my car, it's going to be there, or my watch is on eBay. And these are all real ones that we've had. and that's where the deposit is coming from. But if we can't track it back and the lender can't track it back for 3 to 6 months, their anti-money laundering guidelines are going to say, actually, we don't trust where this money is coming from. So it's really clear that you get that set up and established and evidenceable before we start an application. If we can't track back where that deposit's coming from, the underwriter's not going to be happy where that deposit's coming from. If it's coming from multiple sources, it's going to be more complicated. Doesn't mean it's going to be a no, but it's going to be complicated. Most of the deposits that we're kind of seeing at the moment will either come from savings or they'll come from a gift. And I'll talk about actually intercompany ones as well. If it's coming from your family, 99% of lenders will accept it as immediate family members, mum, dad, siblings. A few lenders will accept it from a slightly extended family like uncles and aunts. Most will want it from direct family members. If you have a trading company and you set up a standalone SPV and you want to transfer the money between one company to the other, not all lenders will accept it. They will accept it in the form of a director's loan, i.e. you withdraw the money from your trading company, pay the income tax on it and put it into your SPV. It's not obviously beneficial to you guys, but it's an acceptable way of doing it. But a few lenders will accept an intercompany loan. So you can move the money from your trading company as long as you've got the same structure, same director, same shareholders going from one entity to the other. That will be an acceptable source of deposit for some lenders. So once we've got you guys sorted out on actually how to apply, and you've got all your application nice and neat and tidy and made the broker's job really easy, fantastic. Then we look at the property types. And this is changing quite rapidly because so many different types of property are now becoming mortgageable that lenders' criteria needs to adapt. But if it's quite straightforward and it's a simple, standard, what the industry would call vanilla buy-to-let, it's a standard letting. The property is an ordinary single-unit residential property with its own freehold or long leasehold title. It will have no commercial element to it at all. And this is where we're seeing a lot of change at the moment in terms of tenant types. So tenants in receipt of housing benefit now more widely accepted, and we've lobbied quite hard for DSS tenants to be an accepted form of tenant, whereas a lot of lenders would shy away from that type of tenant in the past. Don't know why they see them as a risk when their kind of rental income is guaranteed. Student let's obviously really popular at the moment with the HMO market growing probably the fastest out of all the markets that we see. Housing association, where we're lending to people that are actually leasing their property to the housing association, that's more widely accepted now. Corporate lets becoming more accepted now, so we're seeing quite a lot of corporate lets, again, going down sort of southwest in Bridgewater, where you've got big power stations, or around universities where there isn't enough university housing, so companies are coming in, or where you've got large industries like Vodafone and people like that, then corporate let is becoming an acceptable form of tenancy. We're also looking at the building types becoming more acceptable. So ex-local authority has always been a good market for rental return. Properties are normally in prime locations and high-speed train links, obviously all around some social housing areas. And that's becoming more accepted. But lenders will want to know, and it's worth doing your research on the percentage of privately owned property in that area. So if you're going to buy a block or a property in a block and it's ex-local authority, do your research and find out how many are actually privately owned, because each lender will have different caps on how many they will accept. Construction types are an interesting one, and we can talk about the reasons why, whether it's Grenfell or whether it's large concrete slabbed blocks, which obviously start to crumble and corrode, so lenders aren't comfortable, whether it's steel frame construction properties that potentially start to corrode and rust, whether it's got a flat roof, whether it's a grade 2 listed, whether it's got a thatched roof, all these types of things. If they're non-standard construction, each lender's going to have different criteria and potentially request different types of valuation on those as well. The listed buildings are an interesting observation to make when it comes down to looking at your application. So I'll digress slightly. If your property hasn't got an EPC rating of E and above, it'll get a 0 valuation. Under new legislation, it's not fit for a tenant because it's not nice and warm and cosy. If it's a listed building and obviously you can't change the sash windows or change the heating in there, then it's going to be exempt. But it's worth understanding what, before you purchase a property, the EPC rating is. And flats over commercial, I think potentially, without being remiss of what's happening to the high street at the moment, we're seeing more and more purchases of flats over commercial. Lenders are comfortable with flats near commercial over commercial, but you're going to be surprised at some of them that will cause issues. So obviously we'd all think, okay, if it's over a kebab shop, then it's going to be problems. If it's over a nightclub, it might cause problems. But some of the biggest issues for lenders are things like over a laundrette, because of the fumes that come out the back and the ventilation. So just be mindful of where you're buying in terms of what commercial it's near as well as over. New builds, we see a lot of the stands here today with new builds and buying off plan. Lenders are okay with new builds. They will probably restrict your loan to value on a new build purchase. Lenders kind of, without being remiss of it, will kind of look at a new build purchase and liken it to buying a new car. That as soon as you drive it off the forecourt, it's got some depreciation in there before potentially it finds its true value. So you're probably unlikely to get the same loan to value on a new build purchase as you would if you were buying an existing property. Mixed use properties. So if you are looking at a freehold title that's got a flat above and a commercial below, lenders are comfortable with this. I was going to get properly heckled then. A couple of lenders will look at the rent that you get from the flat. And if it's enough to cover the rental stress test for the whole block, then they'll ignore the commercial element of it, as long as the commercial element is not more than 40%. So lenders are actually starting to change criteria. So it wouldn't necessarily need to be a commercial loan if it's a mixed-use building. So there's quite a lot of change going on in that kind of area. We're familiar with the HMO and multi-unit, lots of legislative changes around there. Be very mindful if you're going into the HMO market. If it hasn't got the licence, you need to check local councils to see if it's got any localised licensing issues, see whether it's in an Article 4 area, so it needs the planning permission to be an HMO, check these out. If it's got existing rooms that maybe have been converted in the attic, it used to be that the floor plan was fine, but now it's actually the standing space. So if it's got slanting roofs, be really careful of what existing rooms are. There's minimum room sizes for HMO. So be very careful when you are going into the HMO market that the property in its existing form meets current legislations. Because when the valuer goes out and sees actually it doesn't, you're going to be receding on your application and potentially not purchasing, or spending quite a lot of money potentially on bridging to put that property into order before you purchase. And the other area that's on there is holiday lets. Holiday lets and short-term lets. This is a real growth area in the market. The rental returns that you will get on a holiday let probably far outweigh most AST sort of short-hold tenancy income at the moment. Lenders will look at holiday lets with an open arm, but they potentially might calculate how they lend differently. They might think that you, in a peak season, get £2,000 a week on this property, but as a rental property, it might only get £800, and they might stress it based on the 800. Or they might ask a letting agent to give a low, medium and high valuation and take an average over 46 weeks. But there's different ways for them to actually calculate how they will fund a holiday let, and they will do holiday lets in most locations, but they won't do holiday lets on a holiday park. It needs to be a house in a holiday area. Okay? So the market's changing, the building types and the property types are changing, the tenant types are actually expanding to what's acceptable and what's not. And the mortgages itself, because of lenders' criteria, are adapting quite significantly too. So most of you, I presume, have either got a buy-to-let or have started to explore the opportunities to what funding you can get to buy your first buy-to-let. There's a couple of lenders out there will actually go to 85% loan to value, so you only need a 15% deposit. That's fantastic. Okay, rates will be reflective of that. The higher the loan to value, probably the higher the rate, just to make sure you're aware of it. You're not going to get the high street 1.992 year fixed at 85% loan to value. Most pricing hits its kind of optimum and peak pricing at a 60% loan to value. Most lenders are geared up to lend around 75% loan to value. That's the norm. Okay? You'll find if you've got a property and you want to borrow 75% loan to value, the way that lenders will work it out is the lender's stress test, the ICR calculations. They're slightly different whether you're buying in your personal name or you're buying in your limited company. If you're buying in your limited company and the rents on these two properties are identical, lenders will lend you more up to the maximum loan to value if you're buying in a limited company, because the stress test is more favourable because your tax situation is more favourable. So there's more income to play with in that respect. Okay? So there's a guide on there roughly on how, at the bottom, you can kind of work out what you would get on personal or limited company. But if you were buying in a limited company, it's 125% stress test. If you're buying in your personal name, it's 145% stress test. But, there's always a but, be careful, because lenders will stress properties differently as well. So they might stress your normal single unit AST one bedroom flat on a limited company application at 125%, but if it was an HMO, they might stress it at 160%. So again, it's about speaking to brokers to understand which lenders do and don't stress different properties in a different way. Should you be in a situation where actually you found the ideal property, it's fantastic, you think it's a great buy, you think it's got great potential growth, you know the rental income's not quite good enough, but you're really comfortable, you're buying in a prime postcode location, and this is going to be the nest egg that in 10 years' time has grown significantly, but rent's not quite there. Lenders will top slice. So what I mean by that is they will income back your application as well. So if it doesn't meet the rental stress test, they can use your own personal income to top up that rental shortfall, which is fab. But that will potentially lock you into that lender because it won't make you remortgageable to any other lender. So if you do that and 2 years' time you need to remortgage, you're potentially stuck with the same lender. So just be mindful of that lock-in if you're going to use top slicing or income-backed mortgages. If it's a good income, then fine, no issue, you won't need to use it. Not all lenders will use it. Some lenders will only use your personal income. Some lenders will only use income from your portfolio. So again, the benefits of speaking to a broker are kind of quite prevalent at the beginning of an application. That's a boring slide, isn't it? So I put that up there, realistically, because when the changes came into effect in 2016, regards to stamp duty on second properties, everyone went boo into the market, and there was a massive spike in lending in 2016. It was huge spike in lending. And everyone went in at kind of a really cheap rate because they rushed in to get their property in 2016 before they had to pay this additional 3%. And they all bid 2-year fixed rates. Brilliant. So then they all came to remortgage at 2018. And the PRA had put their guidelines in on how they stress rental income. And you're thinking, actually, most of these deals won't work on a 2-year fixed rate anymore. They only work on a 5-year deal. So is that why everyone's doing 5-year deals? And actually, when you see the green line below, that's the residential 5-year deals. So there's a direct correlation between people using a 5-year fixed rate purchase or fixed rate money doesn't really have any impact on the kind of stress tests per se. There is no doubt that there's a lot of mortgages out there that are on the 5-year deal because they didn't work on a 2-year, but actually people are buying on a 5-year. Now we can't, as mortgage brokers, advise you to do 2-year, 5-year, 10-year, 20-year mortgages. What we can show you is what the customers are doing, and 5-year swap rates are probably at the lowest they've ever been. So 5-year money now compared to 2-year money is marginal. There's not a lot of difference between a 2-year fixed rate. Worst case scenario, probably 0.5 bips, half a basis point between the two. But if you consider at the end of your 2-year period, you're potentially remortgaging or doing a product switch. Let's say you remortgage, you're paying another arrangement fee, potentially another valuation fee, and potentially some legal fees. You do that every 2 years, and you're most likely to save the difference between a 2-year and a 5-year fixed rate if you stayed on a 5-year deal. Most likely, caveat, not an accountant, not an actuary. But you've got to go through that process every 2 years of getting your property revalued, remortgaged. Then we come on to the kind of specialist areas of buy-to-let. So specialist areas of buy-to-let we'll look at, and the reason why I bring it up is because people think, well, I've seen this rate on the high street and it's 1.99 or it's 2.49, can I have that? I'm buying an HMO and I'm buying in a limited company and my deposit's coming from a trading company, you're in a specialist area. So the rates potentially very well reflect the specialism required to actually get the deal done. Buying in a limited company, we've mentioned, if you're buying in an SPV, you can set that SPV up, it's registered at company's house. If it's visible at company's house with the correct standard industry code on it, the SIC code on it, you can put a mortgage in that company the following day. It's no trading history to it, there's nothing. You as the director of that limited company will provide the personal guarantee, and it's you that the lenders will underwrite, not the company, because there's nothing to underwrite from the company point of view. If you're buying your property in your trading company, I mentioned it earlier, then yeah, they're going to look at 2 to 3 years worth of trading history to make sure there's no detrimental impact on you buying a property within that trading company. Lenders will lend to limited liability partnerships and lenders will lend to trusts. Not all lenders will lend to trusts because of the complexity of them and understanding them and potentially unravelling them should we need to sell the property. But there is more and more people, and there's lenders now considering actually, if you're buying a property in a SPV, should you have one property per SPV? Or should you have multiple properties in an SPV? So without switching you completely off, if you've got one property per SPV and you sell that company rather than sell the property, it's a share purchase agreement and you're going to save significantly on your kind of stamp duty implications rather than actually, as a buyer, having to pay the stamp duty. You're going to pay corporation tax on the share purchase rather than a property purchase. So there's lots of things that lenders are thinking about doing to maybe compensate for the penalties that you as landlords have had to suffer over the last few years. Property types we covered. Houses are multiple occupation. Lenders out there will be comfortable around 6-bed HMOs. We've recently placed a deal for a 32-bedroom HMO, which was 4 houses all knocked into one and one title created. So there's some creative lending out there, but be realistic about, if you're not experienced or you're going into that market, about what is manageable, what's achievable, and where lenders find their comfort zone. Multi-unit freehold blocks, again, similar to the HMO kind of licensing on number of rooms and number of units, but be careful of the freeholder-leaseholder relationship as well. So if you're owning the freehold and you want to own all the units within it and you've created the leases, they've got to be in different names. Own the freehold in your limited company and the leaseholds in your personal name, or vice versa, not a problem. And lenders will be concerned about exposure. So if you're looking at a block and you've got three units in that block mortgaged and the block's only got 6, that's probably the max they're going to look at going to. Lenders will be around 25 to 30% exposure in a block. Semi-commercial we covered. Commercial, yeah, the commercial market is growing significantly because, again, I think the high street, unfortunately, is on its decline, so there's more commercial property available, and change of use or conversion to residential is a growing area to look at. You've got to make sure you've got the planning in place, the change of use applications in place, and your lenders will want to know kind of actually what it's going to be worth and what rental income it's going to be worth when it's finished. And then auction properties. Auction properties is another area we're seeing lots of growth in. Lenders have adapted their kind of strategy around auction purchase. It used to be a straightforward bridging finance, and now there's refurb finance. So a lender will look at you buying a property not fit for habitation and not fit for tenant in its current state, and value it in its current state, give an estimated value on completion or gross developed value when you've done all the work, and give you a seamless exit onto one of their buy-to-let properties. It used to be 2 separate deals, and now there's lenders actually transitioning all the way through to make it simple. But it's about the exit strategy, so they'll value it as it is, a re-inspection when you've done the work, same solicitor, same underwriter, taking the whole process through. It's a common, or more common, purchase now potentially than a straightforward auction purchase, because in a normal auction purchase they're going to be concerned about the exit strategy, and that's potentially with a different provider. So it's a growth area. Portfolio landlords, I think we've mentioned a little bit. If you've got 4, and I'm going to dispel a myth quickly as well, if you've got 4 or more mortgaged properties, whether you own them in your personal name, your trading company, or your SPV, you own 4 or more mortgaged properties. Okay? Lenders will not accept that you actually own these 4 over here in a limited company and that 4 over there in another limited company and these 4 over here, but you've got 1 in your personal name, so you've only owned 1 property. 4 or more mortgaged properties makes you a portfolio landlord. The implications at that point, when you are applying for your 4th mortgage, and I will word this candidly, is lenders will become inquisitive. They will become inquisitive about your tax situation, how you've declared your income on those last 3 properties. They will want valuations on your existing portfolio. They may do AVLs, automatic valuations. They may do drive-bys, or they might dip test and send a value out to some of those properties. They will do the EPC ratings on your existing property. So you need to make sure your existing property is in order before actually applying for that 4th. If you've got a portfolio that's out of sync with what they would lend on, let's say, for example, you own 20 properties, all those 20 properties, for example, are ex-local authority and geared at 80% loan to value, and you want to buy another ex-local authority now, this is the first one you've done post-2016, they're going to be reluctant. They're going to look at your portfolio as a risk, how it's geared, what your market is in, where they're placed, and actually they will stress the back book of your portfolio to determine whether they will lend on your new property. Not all lenders will do it. Some will take the PRA guidelines purely as a guideline and don't think they need to adhere to it, but most will adhere to it as a way of actually stressing your existing portfolio. But they will be inquisitive about your tax. If you own 10 properties and your tax return shows that you declared £100 income last year, they'll want to see your SA 100s. They'll want to see where all those expenses and costs and write-offs and down valuations have come into it to make sure it's realistic.